Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. Again, a great show for you this morning. Make sure you do send us your questions to Brian Rezny at ReznyWealth.com, and do visit our website, ReznyWealth.com. We have some upcoming workshops, how to protect your wealth from bad investment advice. Click on our workshop tab. Sign up. We've got locations, of course, right here in Fort Myers and in Naples. You know, I want to talk a little bit about it, not only the economy, but in the direction we're headed, but also really we're going to take a lot of calls and questions in regards to your concerns. The best part of our show, in my opinion, is always getting your questions, because everybody has a specific question that is a concern of you. If you have one, again, send it to Brian Rezny at ReznyWealth.com. Today's topic, I want to talk about investments to avoid. You know, the economy is doing well overall. We don't really have signs of an overall recession, but that could be looking down the road, obviously, maybe later this year, maybe next year. Again, that's why active money management with risk management is important. But I want to talk a little bit about investments to avoid. I've been managing money for over 30 years. My firm is a fee-only fiduciary money manager, meaning we actually manage money. We're not a Wall Street firm. We're not a bank. We're not one of these annuity salespeople, what I call these annuity charlatans that basically sell unsuspecting investors annuities. We are a fee-only fiduciary firm. What that means to you is we legally work for our clients 100% of the time, where most firms do not. In fact, in our estimation, 90+% of investment advisors or investment firms, let's say, or so-called advisors, are really salespeople under suitability. Buyer beware. Today's show is exactly about investments to avoid, because you, the investor, have to understand before you're sold. Once you get into a lot of these bad investments, you can't get out of these things, either A, without surrender penalties, or over long periods of time with often lousy returns and high expenses. The hit list, for me anyway, the biggest culprit, the worst of the worst investments that you can be sold as an investor are annuities. There are no good annuities. There's just annuities under suitability that are sold to you, the unsuspecting investor. There's two types of annuities, basically: a variable annuity and what's called an equity index annuity. Variable annuities are somewhat tied to the stock and bond market, have very high expense ratios, have tax structures that are higher than long-term capital gains rates. So basically, you insanely put your money in a variable annuity. You have big surrender penalties to get all of your money out immediately. You have high expenses, which waters down your return, yet you still have the risk of the bond market or equity market. These things should be completely avoided. There's no investor that should ever be sold a variable annuity. Equity index annuities, in my opinion, are even worse. These are sold by these annuity charlatans that mislead you, the investor, about free money bonuses, which are not on your actual money you can take out on day one. They talk about 8% non-factual returns, which again, these are how these things are sold. Misleading. Equity index annuities are sold to you, the general public, under, in my opinion, a lot of misleading information and really the sales job done against you and your money. Equity index annuities cannot make stock market-like returns. In fact, most of these programs are designed to make 1.5%, maybe 2% long-term returns annualized, kind of like CD rates. And for that, you insanely lock your money up. Maybe it might take 10, 12, 15 years to get all your money out without any penalty. Go buy yourself a CD. You're better off. These income for life plans they tout, again, garbage. No inflation protection, only good for the salesman who is not a fee-only fiduciary, but only working under suitability and only cares about their pocketbook and the commission they earn. How not to get ripped off when buying an annuity? Simple. Never buy one. Go to my website, ReznyWealth.com, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It is a free instant download report. It's a must-read report for any of you who've been suckered, unfortunately, into buying an annuity, or maybe somebody's trying to sucker you into buying an annuity now. Before you get hooked into one of these things and you ruin your retirement or retirement security, read the report, understand what you're getting yourself into. No annuity is good. There's better ways to handle your money safely. If you want guaranteed returns, go buy yourself a CD at the bank. You've got liquidity, and you have your money at hand. Another bad investment to buy are what's called a non-traded REIT, a real estate investment trust. These things have basically almost no liquidity. They could have your money locked up for 5, 10, 15, or 20 years. Very high expenses when you get your money put in with basically little or no liquidity at all. Did your broker ever tell you you can actually buy a traded REIT with instant liquidity? Of course not, because they don't make an 8 or 10% commission on a traded REIT, but they sure make a lot of money when they sell you a non-traded REIT. Once you get into these, and when they go south, you can't get your money out. Again, your broker sells you a non-traded REIT to benefit their pocket, not yours. Again, these are sold under suitability. Any firm who sells non-traded REITs is not a fee-only fiduciary money manager. Alternative investments. These are like hedge funds or commodity funds. Again, Wall Street firms, banks love to sell these to you, the unsuspecting investor who unfortunately maybe did not read the fine print. Again, you insanely lock your money up, high expenses, rob your returns. I've often looked at a lot of these hedge funds, these alternative investments, annual expenses often approaching 4+% annually. 4+% annually, annual expense ratio, that takes away from your actual return. You still have a lot of risk, but you're giving most of your money back to the brokerage firm or the hedge fund or the alternative fund. These, again, are sold and often manufactured by Wall Street firms who like to line their pockets, in my opinion, more than yours. If you want to learn more about investing, the disturbing facts most investors are shocked to learn. I cover these, the true cause of poor investment returns and how you, the investor, can fix it. It's easy. Learn how to grow and protect your wealth from bad investment advice from Wall Street firms, these annuity salespeople or charlatans, banks. Watch out for suitability. I have locations in Fort Myers for our upcoming workshops and in Naples. Go to ReznyWealth.com for dates and to sign up. Limited seating. Go there right now. I want to go to my first question. This is Gail from Florida. And again, if you have a question about your portfolio, send it to Brian Rezny at ReznyWealth.com. Gail from Florida, my financial advisor says I can get out of my annuity. I am very tired of the fees and I wish to put my money elsewhere, preferably where it is federally insured and accessible to me without going through a financial advisor. Even though the returns would be less, I feel I wasn't getting the returns on the annuity I was quoted to me. Any suggestions? Gail, you are finally realizing you were sold an annuity probably under misleading information by one of these annuity salespeople. They work under suitability. They don't legally work in your best interest or actually work for you at all. And by the way, that person that sold you the annuity is not an advisor. He or she is a salesman. If you want something safe, conservative, and federally insured, go buy yourself a 2-year CD. In fact, what I would do is, if you want safety, you're not going to make a lot of money, probably not the best option, but go to your local bank, go to 3 of them, get a rate quote on CDs. Take half your money into a 2-year CD and the other half in a 3-year CD. When the 2-year CD comes due, roll that into another 2-year CD and continue on that process. This way, if interest rates slowly move up, which we do expect they will, you'll have a chance to make a little bit higher interest rate, probably much better than the annuity you were sold, with basically zero risk because it's federally insured. Folks, I'm going to go to a quick little break. I want you to go to our website, ReznyWealth.com. Make sure you check out our workshop tab. Sign up for one of our upcoming workshops. If you have a $500,000 portfolio and larger, call my firm, schedule a consultation, or again, visit our website. We'd love to sit down with you, review your portfolio. If you're looking for real advice and real money management, call the number at the bottom of the screen. Schedule an office meeting either in Fort Myers or in our Naples office. We'd love to sit down with you and help get your portfolio moving in the right direction and work with a real investment firm that actually manages your money. I'll be right back. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact. Annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I hope you're enjoying today's program. Again, if you have questions about your investments, your portfolio, your retirement, send them to Brian Rezny at ReznyWealth.com or visit our website, ReznyWealth.com. Schedule a consultation. We do deal with larger portfolios, $500,000 and larger. And again, if you're unhappy with the results on your portfolio, if you're concerned about the advice you're getting, if a lot of the things that we're discussing today are starting to ring true with the bad advice you're currently receiving, it's time you get that second opinion. Call a real money management firm located right here in Florida, Fort Myers and Naples. Call our number, visit our website. Let's go to Dean in Naples, Florida. Our portfolio, $850K in stocks and mutual funds. My question is, we've seen them have as much volatility as the market, but our returns are way less, like 3% less based upon the S&P, from what I can tell. Our advisor says this is normal for a dividend portfolio. Your opinion? Dean, what I would tell you is this: you're probably invested in the wrong places. If your portfolio is mainly individual stocks and mutual funds, which stocks and which mutual funds? Remember, most stocks and mutual funds will pay some form of dividend. So for your advisor to tell you that you're making annualized 3% on the S&P, if you're taking the same risk as the investment markets, if that is your benchmark, then you should be making a similar return. My guess is if you're buying individual stocks in addition to mutual funds, couple things. Number one, individual stocks will not necessarily make you more money. Chances are you're over-concentrated in those stocks, so it's giving you even more risk and less return. That's not good. And mutual funds in general, most of them are bad performers or underperform their base index. That's been proven often by Morningstar, an independent rating service. Expenses are often high. And as my opinion, as I've always tried to encourage every client, get a second opinion on your portfolio. I'd say call our office. Let's see exactly what is in your portfolio, and let's see if we can't build a better portfolio within your goals and objectives. And again, stocks give you more volatility, not necessarily more return, and that could be part of the problem you're currently experiencing. Betty from Burr Ridge, Illinois. When a recession eventually comes, how would that affect BKLN PowerShares senior loan portfolio? Excellent question. Betty, BKLN is basically a floating rate type bond fund. It basically has loans that are built into the portfolio, and it's very short-term duration, typically 90 days or less. So the interest that it earns as interest rates move up, obviously that portfolio can go up in value and or the income you get. But remember, these are loans. They're typically BB rated type loans. They could be affected in a recession. Remember, BKLN is not a government treasury. It's not a CD. It's going to have some volatility. So what I would say is this: while we do not currently see signs of a recession, one day we will have a recession, whether at 6 months down the road or 6 years down the road or somewhere in between. BKLN, in my opinion, is suitable in a quality, good, rising economy that's growing. If the economy starts to get overvalued and overbought, at that point, what I would suggest is if we start to roll into signs of a recession, you probably either want to reduce your exposure to BKLN or eliminate it altogether. Upcoming workshops, folks. The disturbing facts most investors are shocked to learn. The true cause of poor investment returns and how to fix it. Are you receiving poor investment returns? Is the advice you're getting, are you questioning the advice you're getting? Often investors are. We're going to teach you how to grow and protect your wealth from bad advice. So if you'd like to learn some of the things I've discussed, go to our website, ReznyWealth.com. We have workshops coming up in not only Fort Myers, but in Naples. Times, dates are there, and also to sign up is via our website at reznywealth.com. Dean from Fort Myers, Florida. What do you think of Trump's trade war and its impact on the overall economy? Dean, I'm not concerned. I will tell you this. Given how really trade has gone in the U.S. over the last 3 or 4 decades, our government, Democrats and Republicans, have done a lousy job in trade deals. Both sides are at fault. This president, in my opinion, is trying to fix the problems we have. At the end of the day, most of these countries have tariffs against our products, and we have little or virtually none against most other countries. What this current president's policy is to have fair and equal trade with no tariffs. I like that kind of policy. I don't really see a trade war, and in my opinion, these other countries need us way more than we need them. Our country's growing, it's financially strong, and I think this is a perfect time to start putting pressure on other countries to be fair. Remember, China's been stealing not only trade from us for decades, but our intellectual properties. They're the biggest culprit overall, in my personal opinion. I think there won't be any real trade war, and I think net in the next maybe 3 months or so, I think a lot of these trade deals will be finalized, and it only is going to benefit the U.S. that much more because we are the recipient of bad trade deals to begin with. Larry from Florida. Brian, how much upside do you think is left in the market? Larry, it depends which market. Are we talking the U.S. market, Europe, the emerging market economies, different countries? If I'm looking at specifically the U.S., remember, what rises the U.S. equity market is earnings. Our earnings growing, we're currently seeing that, yes. You're going to get some short-term volatility in earnings, but overall, the economy is in the right path. It's moving slowly up. I like that earnings are growing. I like that company revenues are growing. These are key drivers to the equity market. Now remember, we can see a 5 or 10% pullback in the equity markets at any time. We're not seeing signs of recession currently. What you should be concerned about is this. What is your investment strategy, and does that include a risk management strategy when you start to reduce risk of equities when a recession is actually starting to show its ugly head? Most investors, this is what I find managing money for 30 years, most investors, whether they're with a bank, a Wall Street firm, have no risk management strategy. Most of these firms are buy and hold. So they ride it all the way up, and they often ride it all the way down. They don't really do anything when it comes to risk management in a recession. We believe at my firm that managing your money actively with risk management is important. So what I would say to you is this. Call my firm, schedule a consultation. If you're looking for money management services that includes a risk management strategy, maybe you should talk to my firm, get a second opinion so that you can have maybe more comfort in knowing that a firm is not just setting and forgetting, but they're actively managing the upside and the downside risk. I think that's incredibly important in today's economy. Ken from Fort Myers, Florida. We have 2 Lincoln Choice Plus variable annuities. I really don't understand the expenses, and the annuities have performed poorly over the last 5 years. Our investment, $250K, is now worth $257. We have procrastinated coming to see you for a second opinion. Help can we get out? Ken, first part, you may be able to get out of those annuities. There may be a penalty. We'd have to look at the actual annuity contract. The big problem you face, and this is with annuities in general, so I'm going to kind of put it this way, because I know a lot of our listeners, not only on my radio show, but also this TV show, have been sold some kind of an annuity. Annuities in general, variable annuities, equity index annuities, these things all have expenses. Some of these expenses that we have seen have an annualized expense ratio every year against your return, 3.5%, 4.5%, 5.5% a year. So think about this. If you made 8% on your money and your expense ratio is 4, how much are you keeping? Only 4. But you still have the risk of the investment markets. This is the problem with variable annuities. Investors don't understand what they're getting themselves into because unfortunately, your so-called advisor, that broker, that person that you think is your buddy, unfortunately is really a salesman working under suitability. Cares more about the commission he or she earns than your financial well-being. There are better ways to handle your money versus any kind of an annuity. A cheaper way, in my opinion, a better way. Investors need to understand the expenses. Expenses matter. Variable annuities, and the reason you probably have lousy returns, the expenses are sky high, the investment options are maybe not that great. Combine those two together, you haven't done very well. You are definitely a candidate for a second opinion at my firm because clearly you're smart enough to realize you procrastinated long enough and you realize a second opinion is now warranted. I've got to take a quick break. Go to ReznyWealth.com. We have offices right here in Fort Myers and in Naples. Schedule a consultation. We do deal with larger portfolios, $500,000 and larger. If you're looking for advisory services, if you're questioning the direction of your portfolio, it's time you talk to a real money management firm. Real advice, real money management is the difference we provide. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. And we're back. Hi, I'm Brian Rezny, president of Rezny Wealth Management, and of course, host of this great show, bringing you the information you're not going to get anywhere else. If you have questions about your portfolio, please send them to Brian Rezny at ReznyWealth.com, and make sure you do visit our website, ReznyWealth.com, as we do have upcoming workshops. If you want to get educated and you want to protect your money from bad advice, being sold, crummy annuities, these non-traded REITs, a brokerage account, working with one of these firms with all kinds of fines and censures. I'm going to teach you the disturbing facts most investors are shocked to learn. The true cause of poor investment returns and how you can fix it easily. Learn how to grow and protect your wealth from bad advice. Go to ReznyWealth.com. We have some upcoming workshops right here in Fort Myers and in Naples. Go to ReznyWealth.com, click on our workshop tab for times, availability, and to sign up. Let's go to Kim in Miami, Florida. What do you think about Apple? Kim, great question. I like Apple as a company. I think it's a good investment. I think it's greatly over-owned by most investment managers. What I will say to you is this, whether it's Apple or any other stock, the stock has to have a catalyst to grow, meaning it's growing sales. Is it growing sales and is it growing earnings? That's a catalyst. The other key is it has to have a fair valuation. If you look at the S&P 500, the Standard & Poor's, it trades at about a 16, 17 PE ratio to this year's numbers. If you look at Apple, it's around 15 or so on a PE standpoint. So that means it's not really overvalued against the market. That's a positive. Any stock you own, though, never own more than 5% of any one individual stock. And if you do, trim your exposure. Take profits. Where people lose money is they don't have a buy discipline and they don't have a sell discipline. There's going to be a point in time where you may not want to own Apple anymore, and you may want to take profits to protect your wealth. So again, valuation, is it growing earnings? Is it growing sales? These are important aspects. Apple is currently doing both, but again, that may change in a year or two, and at some point you might want to take your profits and move on to greener pastures. Sam from Cape Coral, Florida. Will the U.S. tax reform lead to growth or inflation? Sam, great question. First off, tax reform, two parts. Corporate tax reform, which has been beneficial, long-term will help grow the economy. Individual tax reform, again, beneficial, will help grow the overall economy. I firmly believe that inflation is somewhat subdued. We're running about 2 to 2.5% inflation numbers this year. I do not see inflation being a big problem. I do see the economy growing, hopefully close to 3% GDP growth for this year and potentially next year again. Again, we look at this stuff on a daily basis. So what we look at today may change tomorrow or next year. This is a moving target. Remember, the economy is always evolving. Unfortunately, investors do not have an adaptive investment strategy, and they don't do enough research. That's why investors often hire our firm. They want a firm that does the research and that can be adaptive and change the portfolio as necessary. I think too often, too many investors set it and forget it. But the economy is growing. That's good. Tax reform is going to help. And I don't see any crazy inflation because people are not rampant spending to push inflation up. That's a net positive. Fred from Naples, Florida. My wife and I, both 67, recently retired. Our advisor wants us to put $700K into an equity index annuity for income, lifetime income. What can a retiree do to protect themselves from inflation? Will this help? Fred, do not do it. You've got a salesman. You are making a huge mistake. Equity index annuities are garbage in our opinion. First off, if you're looking for inflation protection, there isn't any with an equity index annuity. When you open that spigot, whether you annuitize or take these income riders that these so-called annuity experts tell you, you get the same amount of money today, 5 years from now, and 10 years from now. Inflation keeps going up. Your spending power goes down. You will make a huge mistake financially by being sold this equity index annuity. Fred, I would suggest you get a second opinion. Talk to a fee-only fiduciary firm. That would be Rezny Wealth Management. Schedule a consultation. We'll actually go through this annuity for you and tell you what the salesperson is not telling you or lying to you about. By the way, the person that's selling that equity index annuity is not acting in a fiduciary capacity when they sell you that. That is a commission product. That means buyer beware. Fred, you're on your own, and if you don't read the fine print, you're going to get suckered into an annuity, maybe with a 10, 12, 14, 15-year surrender penalty to get all of your money out immediately. That's a huge mistake. I can tell you from a lot of experience managing money for over 30 years, investors come to us, unfortunately, after they've been sold some of these products 3 or 4 years in, realizing what they were sold is not what they were told. Buyer beware. Go to ReznyWealth.com, download our free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Folks, if the advice you're getting is not real, then call my firm. Real advice, real money management is the difference we offer. Rezny Wealth Management. We manage portfolios of $500,000 and larger. Get a second opinion. My advice, never settle for bad advice. Always put your interests first and make sure your retirement is secure. The best way to do that, second opinion, go to ReznyWealth.com. And folks, don't forget to check out our workshop tab. Learn what you haven't learned before in order to protect your money from bad investment advice. I'll see you next week.